Bharat Iyer joins us. Bharat, good morning. Thank you for joining us. Thank you for making time to join us. And it's a special day for us. 10 years ago, we started, and 10 years ago, we are standing tall.
Congratulations, Vikunj, on a spectacular journey, and all the very best for the next 10 years.
Okay, but let's talk about the last 10 days and the next 10 days. That's what I think markets are worried about. And markets are worried about Yes Bank, Indiabulls Housing Finance, Diwan Housing. Now, Bharat, these stocks don't even represent 5% or 7% of the market cap. But 90% of the market mind space right now is getting occupied with these stocks. Why is that?
I think the market's key concern is if there will be collateral damage because of contagion. And I guess that's what the market is choosing to focus on right now.
Is that a good idea?
I think it's valid. Market should always be worried. Is the concern completely valid, and should one be, taking your eyes away from everything else that's happening on the positive side? No, I don't think I agree with that. But yes, the market should be cognizant of these risks.
So a year from now, when we will remember that the month of June 2019, is that a month which will be remembered by long-term investors as a month which gave great entry points in some private banks, in some NBFCs, or this is a month which those who were able to understand risk and were cognizant of global trade war, they turned bearish and they got it right? So who will get it right a year from now? Will the bulls regret, or will the bears feel happy?
Well, Nikunj, there's obviously going to be many moving parts. But if I were to look at it purely from an India perspective, I think, it's a great time to be looking at the broad market. I still remain constructive. I think there's upside. I think one can make about 10 to 12% on an annualized basis. Unique opportunities, one doesn't know. It depends on how managements deal with them.
Okay, but in the near term, Bharat, and I do want to get your view on this, there are so many economic challenges. You just talked about moving parts, and I just want to focus on that a little bit. Apart from the distressed assets and the business groups that we're looking at, do you also feel the structural challenges right now are a big concern, or do you feel that you could expect the government to make some key reforms that could help to ease the way?
Well, Abha, the way I'd look at it is, there are three aspects when one's looking at the economy. There are some segments of the economy which are facing distress, particularly the farm sector and the rural sector. So I guess, you need to sort that out, and that requires structural reforms, that requires factor market reforms, be it labor, be it land, etc.
So do you think there's a deeper issue here than what we talk about?
There is a deeper issue here because, this is a malaise that's been, going on for a long time, right? You have a segment which has suboptimal economies of scale and which you are not seeing sufficient investment go into. And so that is one segment where I'd focus on, which requires structural initiatives. Apart from that, I think, there are some cyclical problems. That's basically because, you always have the economy slowing in the run-up to an election and picking up subsequently. And then there are some unique situations. I think, I see a lot of people looking at the broad economy through just the prism of the auto sector and saying that because the auto sector is slowing, the entire economy is in shambles. We completely disagree with that. We've articulated this in the past, that this is a segment that's seeing a very substantial price increase because of various factors in a compressed time frame, and one shouldn't be looking at the entire economy. So I guess, the structural part needs attention. The cyclical part will take care of itself.
So as an investor, Bharat, what do you do? Do you cut the noise and say that let's buy this skepticism in the market? Or would you say that, hang on, because the index is reflective, or index is pricing in the best case scenario? It's been a decisive mandate. You've hit that 12K mark. Those 4 or 5 stocks which have led the Nifty up, they're pricing in the best.
Well, Aisha, the way I'd look at it is that, valuations are not cheap. We're trading at almost 20 times forward earnings. So I don't think valuations is going to do the hard work for you from here onwards. I guess you'll have to focus on sectors and stocks which will deliver earnings growth. But for stocks and sectors which deliver earnings growth, I still see upside.
And those 4 stocks and sectors will come from the Nifty names? Would they come from the broader markets?
I think they can come from both. If you look at the Nifty itself, I think, banks will still do very well in an environment like this. You have meaningful tailwinds, be it a pickup in credit growth, peaking of credit costs, or supportive policy. I think, sectors which are beneficiaries of the government's infrastructure thrust will do well. I think, utilities will do well. I think cement will do well. I think steel will do well. So there are quite a few areas which should continue to do well.
But for any economy to grow, you got 2 pillars, and I'm not saying anything new: consumption and investment. Consumption could go through a bad patch, it will come back. But consumption stocks are expensive. You may buy them for 10%, 15%. You may get lucky with a 25% move in a 2-wheeler or a 4-wheeler. But investment cycle is where the problem is. And my problem is that the corporates who have balance sheet strength, they are levered, and corporates who don't have balance sheet strength, they want to invest, but they don't have ability to invest. How will things get sorted out?
I guess initially the heavy lifting will have to be done by the government here, Nikunj.
How can they do that, Bharat? Because fiscal deficit is a problem for them.
See, there are fiscal issues, but this is where you need them to be innovative. You need them to raise resources through divestments, through sale of assets, etc. And you need them to get the economy going, because as you rightly pointed out, the private sector is not going to invest in a hurry. That said, I wouldn't completely write off private sector investments, because let's face it, utilization levels even for the manufacturing sector in the private side have been creeping up gradually. We are now in the 75 to 80% band, and the minute you see it going past 80%, I think people will start looking at investments, because it takes a couple of years for new projects to start delivering.
So if one works with the positive thesis, and Bharat, you've always shared this wonderful example with us, which is that when demand comes back, it will surprise everyone. So demand will come back. I mean, it's nature, it's cycle. Mean reversion is the biggest tourism.
Particularly given our demographics.
Exactly. Demand is large, right? How would you maximize on a demand recovery? Would you buy banks? Would you buy industrials? Would you buy cyclicals?
I think banks and infrastructure is where a lot of the juice is. Because as you rightly pointed out, see, don't write off consumption. As I said, we should stop looking at consumption purely through the prism of the auto sector. I think there are parts which are doing very well, and one can't write it off given, the demographics and the urbanization trend. But that said, as you pointed out, valuations are a tad demanding, and you've got to be selective there. But if you look at the banks, particularly the non-private sector retail-oriented banks, and stocks in terms of the infrastructure segments, I think a lot of them are trading at multi-year lows in terms of valuations. They may have given you a little bit of price performance over the last 6 months or so, but I still think there's a lot of value there.
Okay. Well, let's talk about auto for a moment. You talked about how everyone's seeing things through the prism of auto, but does that keep your view on auto still moderate, or would you be bearish?
We've been underweight the space for some time now, and I think we'll continue with that for a period of time. Because Abha, as I mentioned earlier, between September last year and March next year, you have a 20% increase in the selling price of a vehicle because of increased insurance costs, increased safety norms, improved emission norms, and this was a sector that was already mid to late cycle. And mid to late cycle, if you have such a heavy burden in terms of price increases, the sector is going to take 18 to 24 months.
So where in the consumption basket do you still see scope? Since you said let's not forget about it altogether.
I think there's a lot of value in the new age consumption spaces, particularly in services.
Okay.
And here I'd include things like insurance, I'd include things like financial services, I'd include areas like aviation, for example, hotels. I think, jewelry. I think there are lots of areas where there is good growth happening, and where,
So Bharat, now let me take that point forward. In a sense, I preempted Aisha's question here.
You know what I was going to ask?
It's been 10 years, Aisha, so give me some credit of knowing you.
Okay, let's see.
Okay, I think in last 10 years, if you would have bought NBFCs, you would have made money, correct?
That was my question.
Okay, I need to improve on it. Okay, now a question, please.
Yeah.
And my question is that in last 10 years, if you bought into NBFCs, you really made serious money. 20 years ago, if you bought an HDFC, or for that matter a Kotak Bank, you can retire really at 40 or 50.
Yeah.
Next 10 years, the same stocks will not make money.
They may make money. Let's not write them off. Some of the private sector banks have been compounding for 25 years now. Some of the consumer names have been compounding for 40, 50 years now.
They may be compounders, but there has to be something else which can give you better compounding in next 10 years.
Because the biggest mistake we make is looking for the next fad sector. And you do have these sectors coming up from time to time and making money. But never write off the bread and butter space, because that's something that cannot be disrupted easily.
So because next 10 years, put in more money in HDFC Bank and Bajaj Finance.
See, the biggest theme I see in markets right now is that there are so many areas that are being disrupted because of technology. And what you want to really see is, forget sectors. You want to see companies which can, be at the forefront of this disruption. And, people are still going to need banking and financial services products. People are still going to need consumption products. So, it's not about the sector not doing well. You'll need company managements who can see through the rate of change and be the disruptors themselves.
That's exactly my point, because in China, it's the way you bank and whether or not these banks will be able to catch up or not. China, you swipe a card for just everything.
Yeah.
And that card holds everything, your identity, banking, what have you. Can these banks transition along with the globe?
Aisha, I think a lot of Indian companies are actually doing a great job. I mean, if you see some of the leading private sector banks, or you see some of the leading NBFCs also, they're doing a great job in terms of using digital, using data, and doing an excellent job in terms of disrupting the markets themselves. They use data very well. They have access to the best technology. I think some of them are doing a very good job.
So where else apart from financials, do you see the leadership coming in from on the index? A Reliance, an L&T?
See, I think, if I were to look at the next 2 to 3 years, I think, sectors linked to infrastructure, particularly the government's priority areas, is where I see a fair bit of money being made. Because I think, the government is committed to investing substantive amounts. We've seen the manifesto. And I think, there is a commitment to making available the resources. And if that were to happen, and we've already seen it in some areas, right? Look at the last 5 years, look at the progress on roads. I mean, no one would have thought of this kind of activity happening there.
Sure.
So I think, if they get these 4 or 5 areas right, I mean, any and every segment that caters to these should do very well.
And in those pockets, do you see higher returns, more than that 10, 12 annualized?
I think you can make about 12 to 15% or even higher if it's a smaller company, because there the leverage tends to be very high, both operating as well as
Bharat,
financial.
if I take the index 10 years back, the face of the index was different.
Yes.
And that's how natural progression happens.
Yeah.
Index changes. It changes colors, it changes components. Right now, financial services or banks plus NBFC plus financial services, they account for 35 to 40%. Will that change? That's a. Which are the companies? And I'm not talking about you to give me stock recommendation. I'm simply talking about how the face of the index could be, or Nifty could be. Let's make it Nifty after 10 years.
See, Nikunj, I think what will happen is, don't be surprised if financial services continues to account for about 30%. Okay. We are an emerging market with a long way to go in terms of our evolution. But within the composition of financials, there could be meaningful changes. You could see insurance having a bigger weight. You could have, wealth managers having a bigger weight. You could have the services coming to the forefront at the expense of, the conventional banking. I think areas where we are underrepresented in as a market, one area is, consumption. Because you have very few companies out there. You'll have a lot of new age services coming in, as I mentioned, areas like aviation or hotels or insurance, so on and so forth. The other thing to also watch out for is technology, because we have very few internet related companies in the indices, whereas if you see globally, they typically tend to be a large part. And I get, that is one area where you'd want policymakers to be a little more proactive, because all these companies have grown largely through private equity capital, and you don't want the next stage for them to go and list overseas in some exchange. You want the listing to be captured here so that Indian investors can participate in their growth.
That's exactly an extension of the point that we were discussing earlier as well. The last 10 years have been about creation of Amazon, Facebook, Instagram, big brands. Back home, it's been Patanjali, it's been Titan. Britannia has only grown further. Parle-G, the glucose biscuit, is there, but you've graduated from that. Where brand-wise, within consumption, do you see that big disruption coming in?
See, I think the internet space is very interesting if you ask me, because what's going to happen is that a lot of companies were basically surviving because they had a very good distribution moat around them, and these companies are going to disrupt that moat, and so I guess there's going to be a lot of value that's going to be discovered here. And which is the reason, as I mentioned, this is one area where, again, Indian entrepreneurs have done very well. You look at it segment by segment, they've done very well, largely on the basis of private equity.
But in the times of internet, I mean, distribution can happen.
Exactly. So it's not about the distribution mode being important anymore.
Yeah.
Now we are back to, having product, having flexibility on product, and having brand.
Yeah.
Okay, the good news today is Diwan Housing, up 4%.
Oh.
The bad news today is Reliance Capital, 7% down.
What about Yes Bank?
It's flat, I think. 114 flat. First these stocks have to stop falling, Aisha. Then only you can talk about, are they rising right now? We're talking about surprise, and if you look at the sectors which have given you maximum returns in last 10 years, well, it's FMCG right up there. It's private banks right up there. These are sectors, some would argue that, people like Bharat who've been investing in market, they knew private banks would create a lot of wealth. These guys bought and told their clients to buy into FMCG. But I'm sure 10 years ago, after Lehman, no one thought that Indian IT stocks will give you this kind of return. TCS today is India's most valuable company, $100 billion. First Indian company, or the second Indian company to turn $100 billion after Reliance did in 2005 or 6. Are you surprised that IT has given you, the index is up 3x in 10 years? I mean, why has everybody gone wrong in predicting IT?
No, I don't think anyone has gone wrong, Nikunj. I think, basically what happened was IT was the poster boy of the previous bull market. And, the return expectations were very high from this sector. And so there was this natural bias saying that, look, I mean, they've done so well, can they continue to do as well? And, let's face it, they've not done as well in terms of, if you go back between, say, 1996 and 2009, the kind of returns they gave you, they've not given you the same return. But, I'd like to make one point there. I guess the returns over the last 10 years have actually been driven largely by valuations because of easy money that was put out by central banks in developed markets. So if you see the best performing stocks, I mean, a bulk of their return came because of valuation re-rating, not necessarily because of earnings growth. I guess in the next 10 years, what you need is earnings growth, because valuations for most asset classes, including equities across the world, are trading at very meaningful premia to their long-term averages. So here onwards, valuations, it's very difficult to call for more re-rating.
In next 10 years, are we in for a gut-wrenching global fall, a fall which the Ray Dalios and the Harvard Marks of the world have been warning for from last 3 years, because that changes the way how stock valuations and inflation-related returns would be done. Are we in for a repeat of 2008? Is that coming? If not this year,
see, I don't know if you're in for a repeat of the 2008, because every crisis has its own characteristics, which is quite different from the prior one.
No, I'm talking about price, collateral price
exactly,
damage.
but could there be a fall in equity market sometime between 2020 and 2022, given the increasing calls for a recession sometime in that time frame? I wouldn't rule it out, and I would be prepared for it.
But if everybody is prepared, and if folks like you are officially using the word recession in their communication, it's like saying that, look, markets are secretly getting prepared for it.
Not necessarily, Nikunj. I think what happens is, like, if you see, money has been flowing into equities very, very consistently over the last 3 or 4 years. And what you really need to see is money being pulled back. And when you see capitulation, that's when, markets really actually start falling off. Not that, trust me again, I don't have the competence, nor am I calling for a recession, but one increasingly keeps hearing about the possibility of it, which is the reason I would be careful over a 2-year period, because, it's something that if, what we hear pans out, then one needs to be prepared for it.
All right, just a note on, since we touched upon central banks, here in India, how much more of a room for a rate cut do you think? And, given that it could be the stimulus we need?
See, I think there's room for another 25 to 50 basis points. Inflation is remarkably well behaved. So I guess, and as Nikunj pointed out earlier, there is the limitations in terms of easing fiscal policy further. So perhaps monetary policy has to do a bit of the heavy lifting. And so, I think there is scope for 25 to 50 basis points.
Okay, Bharat, great to have you on the show.
Thank
Glad
you so
that you
much,
could take
and
time.
all the very best for the next day.
Thank you. Thanks so much.